Regional banks came under pressure late last week on credit concerns. Affected the overall market as well, you would think. Zions Bancorp and Western Alliance getting caught up in the investor fear. Join us now for more. Scott Siefers, Piper Sandler, senior research analyst. There are some other things, too, I guess, related, not the same. I think you point out that this, and what we just mentioned, might have been an example of fraud, not necessarily just overall lax credit. And it's tens of millions. It's not even billions at this point. And Jamie Dimon, no, Scott, says, cockroaches. You never see just one. Couldn't the cockroach be lost? It's possible. I mean, ants, no way. When I see ants, there's always a bunch of ants. But a cockroach, maybe he's lost.
Yeah, no, I think last week's market volatility, at least for the regional banks, probably a little overdone. People are agitated. I mean, appropriately so. You see credit problems and people tend to shoot first and ask questions later. But I think the broad reality is what we've seen are a couple unrelated and idiosyncratic events. They've all been under the umbrella of the same type of thing, but the only common threads are, one, they seem to be fraud related, and two, they're falling under the umbrella of this thing called NDFI, which stands for non-depository financial institutions, which is sort of an opaque asset class, but people are just coming up to speed with what that even means. It's just the newest acronym to rattle the industry. So once we get a little education out there, I think things will calm down pretty quickly. So
the other one, the tricolor and the first what's it called? First Brands.
Yeah, I think tricolor, First Brands, and then there was last week the CRE,
Zion, Western Alliance, but.
Yeah. So, these things, that they're issues, and it's good that we're keeping the banks sort of honest under more scrutiny. But again, when I look at the earnings season, which we're going through right now, things are actually quite strong. Loan growth is fine. Banks are contending with the interest rate environment really well. They have a ton of capital. The capital markets are super robust. So the actual earnings and fundamentals are very good. And just as I think about sort of these little credit hiccups that we're seeing, they're certainly not big enough to cause sort of systemic worries or anything like that.
There's a big piece in the Journal today in the op-ed section about maybe some Republicans, I guess, and even President Trump's, and I think the Treasury Secretary actually expressed some support for raising the FDIC insurance to something like $10 million from $250,000 just for the regional banks. The Journal thinks it's an awful idea because it increases moral hazard. They don't need to be as cognizant. What we really need is less regulations. But does it make sense to you? Didn't Janet Yellen basically say we'll cover everything when Signature and some of these other banks were having problems?
Yeah, well, ultimately, that's how we got out of the last little mini crisis with the regional banks. A couple, what was that, 2.5 years or so ago, is the Fed effectively guaranteed liquidity. So, personally, it would rather we didn't have to come to a situation like that. But the broad reality is that banks are largely just an expression of confidence, and that's how investors tend to trade them. So to the extent that you've got one issue or one idiosyncratic problem that, as we saw a couple of years ago, can sort of fell a lot of others, that's just not the way the industry needs to operate. So if it means we need to up the FDIC insurance just to keep a certain level of confidence in the system, maybe that's the way we've got to go.
Scott, do you think that what we've seen just in the last week rivals what happened with Signature Bank and the others? Is it even?
Oh, no, not at all, Becky. I think this is completely different stratosphere. We've got a new acronym that we're all kind of coming up to speed with. But what happened a couple of years ago, that was that was sort of a liquidity crisis that runs on banks. I don't think this is anywhere close to that. What we've seen so far are just a couple idiosyncratic, unrelated frauds that have the market sort of on edge for the time being. But again, I think, once people get comfortable that broader credit trends overall are still fine, I think we'll kind of get back to smoother sailing.
Even at the regional banks, 99% of the customers have less than 200. They're already covered, less than 250,000. So you're really talking about, it sounds just like a Silicon Valley bank shares type to cover those people.
Yeah. So, what was interesting last time around is we'd never had a situation where you could have large commercial customers. So really big and chunky deposits all flee at the same time. That was just a new phenomenon for all of us. I remember 48 hours before that happened, when in March of 2023, it seemed like everything was really, really good in the industry. And then you had just this massive crisis.
That's the scary part. That's the scary part. You're just saying 48 hours ahead of time, everything seemed fine. Everything looks fine right now. What are the odds that something could spiral?
Oh, yeah. No, but this one seems, highly unlikely to do so. I would point to, one of the large regionals out there. It's actually one of the best managed names out there. Had, a couple $100 million of exposure, and you barely could even find it in the earnings stream. These large banks have so much capital, so much liquidity, so much reserves that I don't want to say bulletproof, but they're pretty close. They can handle a lot of stress and still keep operating pretty easily.